Today, let us discuss about the commercial banks and their functions. Commercial bank is a kind of financial institution which carries all the operations related to deposit and withdrawal of money for the general public, providing loans and investments. These banks are profit-making institutions and do business only to make a profit. A commercial bank is a financial institution which performs the functions of accepting checkable deposits from the public and making loans and investments with the objective of making or securing profits. Thus, a financial institution can become a bank only when it performs two functions. These are called twin functions. One is accepting checkable deposits from the public and lending to the public. So if a finance institution performs only one function of accepting checkable deposits, it is not qualified to be called a bank. For example, Post Office Savings Bank accepts deposits from the public, but they do not lend, hence they cannot be called banks. Therefore, the acceptance of deposits is a necessary but not a sufficient condition for the financial institutions to be a bank. To be a bank, both the functions are required. Now let us know the functions of commercial banks. Accepting deposits, that is acceptance of deposits from public. An important function of a commercial bank is to accept and attract deposits from the public. Banks accept deposits from individuals, business firms, and other institutions or entities in the form of demand deposits or current account deposits. Deposits in the current account are known as demand deposits because these can be demanded by the depositors, or these are payable by the bank to the depositors on their demand, or it is called repayable on demand. That's why it is called demand deposits. The depositors can deposit or withdraw money as and when they like. The bank does not pay any interest on demand deposits, but in fact makes a small charge on the customers with current account, because to current account holders, bank performs number of activities or provides number of services to the current account holder. That is why the bank charges certain amount of money from the current account holder. So it is repayable on demand, no restrictions in the number of withdrawals. Number of withdrawals means any number of checks can be issued in a day. There is no restrictions in the number of checks. No interest is paid to the depositors. This deposit is checkable, means it can be withdrawn by issuing checks. Current account holder gets the overdraft facility, means they can withdraw more than their deposit balance. Obviously, bank charge a certain amount of interest for the overdraft. This overdraft is provided for a short term, and it is provided only to the reliable customers and reputed customers, not to all. Savings deposits. Savings deposits are those deposits on which the bank pays certain percentage of interest to the depositors but places certain restrictions on their withdrawal. The savings deposits have the features of both current account deposits as well as fixed account deposits. Savings deposit also repayable on demand, but there is restrictions in the number of withdrawals. So it is repayable on demand like demand deposits, but there is restrictions in the number of withdrawals. Certain percentage of interest is paid to the depositors. Low rate of interest is provided. This is also checkable, means depositors can withdraw by issuing checks. But savings deposit holders are not granted the overdraft facility. They cannot withdraw more than their deposits. Rather, they are to maintain a minimum balance in their account. Next is fixed deposits or time deposits. In the fixed deposit account, money is kept for a specified period. These deposits are also known as term deposits or time deposits. Money deposited in the fixed deposits cannot be withdrawn before the expiry of the period for which it was contracted or agreed. A higher rate of interest is paid on such deposits. These deposits are liked by depositors both for the safety as well as for the interest they bring to them. It cannot be withdrawn before the maturity. High rate of interest is paid to the depositors. This is non-checkable. This deposit cannot be withdrawn by the depositors by issuing checks. Certificate of fixed deposit scheme work as collateral security. That every certificate can be work as collateral security. Next is recurring deposits. Under this deposit scheme, a certain amount of money is deposited at a regular interval for a fixed period of time. In this deposit scheme, generally a high rate of interest is provided to the depositors. These deposits cannot be withdrawn before maturity, and this is non-checkable. Second function is advancing loans. The second major function of a commercial bank is to give loans and pay advances out of their deposits. Loans and advances are given to all types of persons such as businessmen, farmers, consumers, and employers against securities. The commercial banks give loans and advances through a variety of ways, such as cash credit. The banks can give loans as cash credits. Cash credit are given mainly on the basis of stocks of goods with the borrower. In this case, a borrower is sanctioned a credit limit up to which he may borrow from the bank. It is not essential that the borrower should withdraw the whole amount of money at one single occasion. The borrower may withdraw the money as per his convenience or requirements. The borrower is required to pay interest on the utilized portion of the credit only. This form of loan is very popular in our country for the businessman. So the important feature of this loan is borrower required to pay interest only the amount which has been withdrawn by him from the bank, not on the entire amount which is sanctioned and credited by the bank in the customer's account. Only the portion which will be withdrawn. Money at call. It refers to loans given for very short periods and generally backed by collateral security. These loans are called as demand loans because these are liable to be recalled on demand. Term loans, there are short-term loan, middle-term loan and long-term loan. That these type of loans, term loans, attract the different types of customers. Overdraft. Overdraft refers to a facility in which a customer is allowed to withdraw his current account up to an agreed limit. This facility is generally given to respectable and reliable customers for a short period of time. Customers have to pay interest to the bank on the amount withdrawn by them. So it is given only to the current account holder and the limited amount is provided, interest is charged and for a short period of time. Discounting bills of exchange. It refers to a facility to which holder of a will exchange bills of exchange can get the bill discounted with bank before the maturity. After deducting the commission, bank pays the balance to the holder. On maturity, bank gets its payment from the party which had accepted the bill. So before the maturity of the bill, the person who has accepted the bill, who has drawn the bill, he gets the money from the bank by discounting the bills of exchange. So this is the facility provided by the bank to the businessman. Agency function. Beside the advancing loans and accepting deposits, commercial banks also act as financial agents of their customers. And these include remittance of funds. Banks remit funds on behalf of their clients by mail transfer or demand drafts. Bank remit funds on behalf of their clients. These transfers give rise to exchange activities. Collection and payment of funds. Banks also collect and pay the checks, bills, promissory notes, dividend warrants, rents, income tax, insurance premium, and other receipts and payments of their clients. Sale and purchase of securities. Bank also sell and purchase shares, stocks, debentures, and bonds, etc. on behalf of their customers. Representation and correspondence. Many a time, banks procure passports, tickets for their customers and act as their representatives. Trusteeship. Commercial banks also act as executors, trustees, and attorneys for their customers. Sometimes bank also appoint income tax experts to prepare and finalize the income tax returns of their clients. Banks also help their customers to get refund of income tax if any. General utility function. Modern commercial banks also perform general utility services for their society, such as issuing of letter of credit and other credit instruments to their customers. Receiving the valuables, ornaments, jewelries, documents, and deed of their customers for keeping it in lockers. Acting as a referee, banks collect information about trade, industry, and finance and also advise customers on financial matters. Issuing of bank drafts and traveler's checks in order to facilitate the transfer of funds from one part of the country to the other. Apart from this, underwriting of loans raised by the government, the public bodies, and the corporation. So, commercial banks underwrites the loans. Credit creation or money creation. One of the important function of commercial banks, they all together create credit in the economy. So this credit creation process, before I explain, let us know its assumptions. The entire commercial banking system is one unit and is termed as bank. And all receipts and payments in the economy are routed through the banks. Means only through the bank transactions. But the limitations of this process, the credit creation capacity of commercial banks depend mainly on primary cash deposits. Commercial banks create credit on the basis of their primary cash deposits. It is therefore clear that the larger the availability of cash, the larger will be the quantum of credit creation. Cash reserve ratio. The higher the cash reserve ratio, the lower the credit creation capacity, and lower the cash reserve ratio, the higher the credit creation capacity. Thus, there is inverse relationship between cash reserve ratio CRR and credit creation capacity. Banking habits of the people. In the countries where people prefer to deal through banks, credit creation capacity will be more, and vice versa. Policy of the central bank. The credit creation capacity of commercial banks depends on the policy of country's central bank, the principal bank, the apex bank. Central bank can control credit if its policy is to encourage credit creation. It will adopt cheap monetary policy. On the contrary, if its policy is to discourage credit creation, it adopts dear money policy. Now let us explain the process of credit creation with the help of an example. Let us suppose the primary deposits with a bank is rupees 1000 and cash reserve ratio is 20%. Let us know some formula. Money multiplier is equal to 1 by cash reserve ratio, and total credit creation is equal to primary deposits multiplied by money multiplier. So it is 1000 and the money multiplier is 1 by 20% is equal to 5, means total is 5,000. Or total credit creation is equal to primary deposit multiplied by 1 by cash reserve ratio. That is sometimes variable reserve ratio or legal reserve ratio. So 1000 into 1 by 20% is equal to 1000 multiplied by 5 is rupees 5000 total credit creation. The bank create credit 5000 with 1000 rupees. Now let us explain this table or this example. Commercial banks expand their deposits by giving loans and advances. They create claims against themselves and create deposits in favor of borrowers. So how do banks create credit? Suppose people deposit their cash money with the banks and it is equal to the primary deposits, that is rupees 1000. Banks know from their experience that all the depositors do not demand all the money at the same time, but some portion of it may be demanded at any time. Hence, keeping in reserve a part of this cash deposit, the remainder can be given as loans. Suppose banks decide on the basis of their experience that 20% of the cash deposit is sufficient to meet the demands of the depositors. This we call cash reserve ratio. That is, central bank determines the cash reserve ratio that every commercial bank is required to maintain a minimum percentage of their deposits with the central bank to meet the demand of depositors. In the first phase, the initial deposit is 1000 rupees. Since the cash reserve ratio is 20%, so the bank will keep 200, that is 20% of 1000 as minimum reserve, and the remaining amount, that is 1000 minus 200, 800 will be provided loans. As the bank will provide loans, the bank will credit this amount with the deposit with the person who has applied for the loan. This 800 will become in the next page deposits, because bank will credit, so it becomes the deposits with the bank. Again, the 20% of 800 bank will keep in its reserve, and the remaining amount is 640 will be provided credit. In the next page, the 640 will become the further deposits. Again, the bank will keep 20% of it, that is 128 rupees as minimum reserve, and the remaining amount 512 will be provided loan. In the next page, this 512 will go. In this way, in the nth term, nth stage, when the minimum amount, the very negligible amount which is not sufficient to provide credit, then the total finally the bank will get, the total deposit is 5000. Loans and investment that is given by the bank is 4000, and 1000 deposit is maintained by the bank. So this 1000 is with the bank, but out of this the bank has given 4000 credit. So the total is 4000 plus 1000 is equal to 5000 total credit creation by the bank. Here is the bank's profit. If you see, the bank gives, suppose 5% or 8% interest to the depositors. So 8% of 1000 is equal to 80. But if the bank charges interest 10% from the persons, those who have taken loan from the bank, that is 4000 into 10% is equal to 400 bank's interest income, and interest paid by the bank 80. So 400 minus 80 is 320 is the bank's profit. That is interest received by the bank minus interest paid by the bank is the bank's profit. So from this example, it is clear that the total credit creation is always equal to the primary deposits multiplied by the cash reserve ratio. In this way, bank can give loans many times over and above their cash deposits. That is why it is often said that banks are the credit creation industries. That's all. Thank you.